It's no secret there has been absolute mayhem in the financial markets, not only the currency markets, but even in the equities, the cryptocurrency space, and many other financial instruments. And in this video, I want to go over a potential reason why this could be occurring. And in fact, I believe this is more likely than not considering what I am looking at here. Without further ado, let's get straight to it. Welcome. If you're new to the channel, my name is Matt Jimenez. I'm an entrepreneur who has worked with the greatest minds in finance over the last several years, and I'm here to pour into you guys everything that they pour into me. And in this video, I want to go over a particular trade that is occurring right now that has potentially caused all of the bleeding across a multitude of markets. And this potential trade is called the yen carry trade. And if you don't know what that is, let me explain. Now, a carry trade is quite popular amongst hedge funds, and it is a way of making easy money, provided that there is not a violent move that occurs during your carry trade. And unfortunately, just that something has already started to happen. Now, in essence, a basic carry trade is a foreign currency trade, and the objective is to borrow in a cheap currency and go invest that back into a more expensive currency. And what will end up happening is you take the difference in the interest rates. So the cheap currency will have a low one, and the more expensive currency will have a higher interest rate, and essentially you pocket the difference. Seems easy and it sounds like easy money, but unfortunately all easy things oftentimes end up being hard. And the reason why the carry trade is happening with the yen is because the interest rate has been so low for so long. In fact, it's practically zero. But what has happened as of recent is they raised their interest rate, which unfortunately makes the carry trade make a little bit less sense. Not only making sense in terms of taking a small financial loss, unfortunately, billions, if not trillions of dollars have been involved with holding yen for the reason of having a lower interest rate and investing it in many other places, but they took the risk on knowing that the interest rate could potentially raise higher. So let's say you borrowed $1,000,000 yen and you took that $1,000,000 yen and you went and invested in Australian dollars or US dollars, whatever it may be. Now that the interest rate goes higher on the yen, you now have to pay the difference of how many yens you borrowed. So if you borrowed $1,000,000 yen and the interest rate moves, and let's say you're left with 800,000 yen, you now have to make up that difference just because of the fluctuation in their interest rate hike. That's what just happened. Let me go ahead and share my screen to show you guys exactly what I'm looking at here. So here we have Japan's interest rate, and the last time they actually raised rates was back in 2007, and the time before that was back in World War II. Something that I find quite interesting here is the interest rate of Japan, and the history of it is almost inverse to the US dollars interest rates, because in 2008 we actually dropped rates substantially as they actually raised them quite rapidly. And the last time they raised, like I said, was back here in 2007, and in current dates, which has caused loads of volatility in the currency market, which caused me to have substantial amounts of losses in a potential trade that was involved with the yen, and I traded with absolutely no stop loss and felt the damages of doing so. Here the interest rate went from negative to a positive 0.1. So throughout Japan's history, their interest rates have been extremely low for quite a while. In fact, peaking into the negative at times. But as you can see, here we are in 2024, and they are currently sitting at 0.1. And while that may not seem like a lot, it's not even a whole 1% from the move that it came from is quite drastic. And we do expect several more, or at least one more rate hike to happen here in Japan, which will cause this to be far worse on the carry trade side of things. And let me explain why that is bad on the carry side, which is causing the strength in the yen dollar across multitude of assets when paired against the yen, like the Aussie yen trade, like I talked about earlier this week, which really brought in tons of volatility and damaged my $50,000 account. So the carry trade goes wrong when there is the difference in the interest rate rising, like I just showed you on the chart. And what happens is yen is your liability if that's where you're borrowing the money from. In this example, for a carry trade, you're borrowing from Japan in yen. So the yen is your liability, and the foreign currency that you're borrowing is your asset because you're getting paid on that interest rate of that different currency. So now what happens is when that interest rate changes and it goes up or down, in this case up, now you're short on the amount of yen that you have. So your liabilities and asset balance is off. So now you have to find a way to get more yen in order to pay back that liability. what happens is you have tons of sell pressure from the other assets, whether that be their currency, bonds, or whatever it may be, back into the original liability, what it was of the yen, which will cause a massive influx into that currency. That's number one. Number two, when you raise rates, that typically is strengthening for a currency. So you have the unwinding effect of all these hedge funds and institutions taking large sums of borrowed yen and finding yield in other locations that now doesn't make sense anymore because of the increase on the interest rate. So they have to offload all of these assets back into the yen, causing not only a surge in the strength in yen because you have all this capital coming back in to get out of their position so they don't get margin calls and take a bigger loss than is necessary, but you also have the effect of the higher interest rates. So the effect on the yen is actually doubled. And like I said, the way the BOJ, the Bank of Japan, has been speaking is that they are definitely a bit more interested on raising their interest rates. Now, I would love to look through some charts and show you guys exactly the yen strength being demonstrated and go over the exact trade that I was in that caused massive amounts of damages. Okay, so here is the Aussie yen pair, and on this is where we see the dramatic strength in the yen. Reason why it's strength is because this is a pair. To the left, you have the base currency, and to the right, you have the quoted, which is the yen. So anything going to the downside on this chart is saying that the yen is stronger than the Aussie dollar, which the yen is the quoted. Now, looking at this chart from when they raised rates and with CPI coming out high and all these other things that impacted it, you had a total move of 14%. And while that may not seem like anything drastic or too much, depending on what market you're exposed to, the last time we've seen anything like this was back in 2020 during COVID. So 4 years since we saw anything remotely close to this. And in fact, while COVID did have a bit of a crash in terms of yen strength, we then again can't even compare the amount of volume on this drop. As you can see, these candles to the downside were quite scattered and broken up, and they have wicks on them, which means there was some buying pressure happening. When you compare it to this here, there's absolutely no buying pressure happening whatsoever. You have somewhat of a small wick over here, but it's not even anything to indicate any type of actual strength coming in. And in fact, the candle right after this one right here closed on the low. That is probably as bearish as you can possibly imagine. Closing on a low means extremely bearish, as if closing on a high would mean pretty bullish. And again, if I just scroll back through history, we're not going to be seeing 15% moves on the regular. We have to look many years back through the data to even find a move like that. And again, here is another one. Back in 2013, we had another 14% drop. And the last time we ever saw anything beat this move was back in 08. And of course, we all know 08 and its historical recession, which had the yen strengthen a dramatic amount in comparison to the Aussie dollar, which was a 46% swing in this pair. Now, I want to touch a little bit more on the carry trade unwinding. And this was a simple Google search of the yen carry trade, just asking, what is it all about? And the first thing that comes up is a CNBC article. But before I do that, let me just read the top of this for you. The rising yen has fueled the speculation about whether this could mark the end of the popular so-called carry trade, wherein an investor borrows in a currency with a low interest rate, such as the yen, and reinvests the proceeds in a currency with a higher rate of return. Again, another example of the carry trade. Now let's just go ahead and see what CNBC has to say about this. An implosion of the carry trade. US stocks kicked off the month sharply lower. The fresh data prompts the fears of a worsening economic outlook. The weak data led investors to worry that the Federal Reserve may be behind the curve in cutting interest rates to fend off a recession. And again, just how I started the video, how I said it's no secret that all markets are experiencing some extreme volatility right now. Let's actually look at the S&P to see what CNBC is actually talking about. And here we are, I have the S&P 500 pulled up for us to look at. As I mentioned, it's not only the currency markets that is experiencing this type of volatility, it's coming through a multitude of different asset classes, and the S&P is a great example of that. Let's go ahead and grab our measuring tool and grab from the height down to the low, which is a 7% move to the downside on the S&P 500 since the Bank of Japan decided to raise rates. And like I said in the beginning of this video, it's a multitude of different asset classes. Let's go ahead and look at Bitcoin since they decided to change these rates. If I was to grab the tool from the high to where we are currently, we are now down 24% on Bitcoin, which is absolutely insane. So now that you have a better understanding of what the carry trade is and how it works and what is the risk, which is the unwinding part, now the question is, what do we do moving forward? Well, I can tell you what I'm going to do. What I'm going to do is actually limit my software's activity. And this is not financial advice whatsoever, but I will be, and I already have, taken off a lot of the yen pairs because I want to stay away from any potential volatility like I experienced before. 1, 2, I'm going to be using stop losses across the board here. I think I'm going to put them around 15% of the total account balance. And I'm probably going to be turning off auto trading when we have these dramatic swings in the market due to fundamental news that comes out, like a interest rate hike and a high CPI. Those are things I don't want to really be a part of because you can't really predict which way the market's going to go in. And if you're already in a position and the volatility goes against the position that you're in, unfortunately, if you don't have a stop loss, you will feel the pain of that. And I don't want anyone to feel the pain of that. Now, I can never give financial advice, and none of this is ever financial advice. This is solely what I'm doing. It's merely just what I'm doing to protect myself and for your entertainment. If you like this video and you're interested in finding out more potential upcoming news releases that could affect markets across the board, please leave a comment, like, and/or subscribe. And like always, my friends, peace.